Hello, everyone. Welcome to the Friday show. Um, Glad to be here. Um, yeah, it's been a good week. I guess it's been a good month. A lot of good things going on. A lot of trend trades happening. Um, Still short interest rates, of course, and long commodities. And oh, my currencies are doing well too. This dollar thing, how crazy is that? Um, Someone on Twitter mentioned the other day, my friend Mike, that when the central banks or the treasuries come in from the different countries and buy up their currencies to stop this downtrend, we're going to really feel it. So that brought back memories from over the years. That definitely has happened. So hopefully, we can survive that. My stops are so far away, which is good and bad. I won't get shaken out, but I'll give back a lot of profit if it keeps rallying. Um, and I got a heavy yen too, so that's nice. I haven't looked at the markets this morning. Who knows? I actually got short Amazon. I think it was like yesterday or the day before. I think it was the day before, and so Wednesday. So I know that was down 300 after the close. I don't know where it is right now. So, anyways, I do short a few stocks and indices, as you know. So a lot going on this week. Hopefully we have a good crowd. Looks like we have the usual good guys and girls on board today. So Moritz is with us, so that's nice. I invited my friend Mike to be on. He writes a lot on Twitter, and he has been critiquing trend following. He's not a lover of trend following, but and he questions performance. So he and I have gone back and forth respectfully debating trends and breakouts and drawdowns and holding on to these profits. That's how well are we going to do when we get that shakeout period. And I invited him on, but he probably doesn't participate. So one thing to think about, I wanted to bring up, and you can think about this and put some notes in the chat, the room chat. That's what it's called. So don't forget to put some questions in there this morning. One of the things I was considering is experimenting with Twitter Spaces. Maybe one of these days on Friday morning, we'll use Twitter Spaces to have our meeting rather than Clubhouse. I know that's blasphemy, but let me know what you think about that. If it's a problem, I think we might get a bit bigger audience and just see how it goes. I've done it a couple of times. Oh, we did it with Tom Basso. And so I think it worked pretty well. But if it's going to cause any of our regulars problems, just let me know. So with that, I'll open it up and we can get our discussion going. And it's open topic, freewheeling. And I'll invite Oleg to speak first. Good morning, Oleg.
Good morning. Hi to everyone. Good morning, Jerry. Good morning, all of guests and friends. Richard, Bruno, Maritz. I'm very happy to see Maritz. So, Brian, of course. So, I want to say that, as always, I'm very happy to be here to speak about trend following, about trends. And as I said in the recent our discussion, that I try to accomplish such a thing that I want to be happy in all circumstances of my trend following program, of my trend following trading. So, of course, now it's a lot of trends. For me, it's near 2 years of good trends in commodities markets. So, of course, it's good performance, but I think that it's very important for me to feel good in all the circumstances, and I remind myself about this. I look at this good performance, at this low drawdowns from the highs, maybe, and um, and I remind myself when this that situation will be changed. The situation will be changed, and I must keep following my rules in all circumstances. And so, if I trade, I'm happy. Here is the point.
Yeah, I mean, me too. And the opposite is true. If I'm not trading, I'm not happy. So yeah, been very happy recently um, with performance and with just every day, sitting down in front of my desk and doing what I've been doing since January 1984, dealing with these markets and enjoying them and um, getting into a situation where it probably was the best thing for me, suited my personality. Um, Sometimes I'll leave in the afternoon and just wonder how I put up with all this stress of ups and downs and relative performance and certainly making some mistakes, not as many as I used to. And I just wonder, like, is this taking some years off my life? But then the next day, it's just like, oh, maybe I didn't get much sleep, and maybe I didn't sleep that well sometimes for some, whatever. And then, but then when I roll out of bed and then I get in front of the screen or in front of my computer, it's just like, oh no, 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 no. I am just where I want to be, where I should be, and just revitalized again somehow, and just trying to. We have a good job in the sense that we can give ourselves a high grade every day if we if we do the trades like we're supposed to, and not necessarily did we make money. Eventually we have to fix those entries and exits and portfolio weightings and get it improve it a bit when we can definitely see evidence that we we've underperformed unnecessarily. And I was just going through looking at some of the tweets this week, and Brian, I mean, it, 40 in, 40 out. He made this statement yesterday, which was, there is no magic in X-day breakouts. Wow, I think that's sort of true. There's no magic. I mean, as certainly as one versus the other, as I've said many times, all my different breakout systems make the same amount of money over time. Um, they're just part of that group of parameters that do pretty well. But boy, there has been some magic in using breakouts, and that's really nice to see that it doesn't look like there's too much better out there. I feel for people who are buying some of these stocks and markets on downtrends and don't really know what to do from a risk management point of view.
Good morning, everyone. Kind of a slow morning here. Um, First of all, on your question about the experimenting with Twitter Spaces, Jerry, on my part is okay. I just wonder if the audience would be much different from the one we have here, and I reckon it should be bigger for the good or bad of it. But sure, I think we should try with Twitter Spaces, see if new people show up. And just one. I want to comment on a tweet I saw this week about someone testing a trend following system, and on the paper or on the questioning, um, the person goes on and apply a breakout system on major indices and try to get the measure the performance of trend following applied on the S&P index, on the GSCI, on some aggregate bond index. And I thought, oh my God, that's complete nonsense. There is okay, that person is taking the one entry, one exit, and one stop rule, I think. But what about diversification? That's half the job we do here. Without diversification, there's no way you can gauge anything about trend following. So I just want to bring this up to you guys, how outraged I felt on applying trend following on a couple of, I don't know, 5, 6 indices.
I want to say here that we have, as for me, maybe two things that I consider maybe as the main things. A lot of course, it's not all the main things, but it's first of all our trend, not trend, our risk management, because without risk management, proper risk management, we will lose all our money or we'll have a big drawdowns, and it's axiom. It will be so. It's the first. The second is diversification. Without a diversification, we can be in a drawdown in a flat period or not good performance for maybe 10, 5, 7, I think years, maybe more, if we trade one sector, one market, or not much sectors. So it's very important. And if a person trade indexes or trade only stocks, and we all know this, so we can see how the sector moves. Of course, the last 10 years, stocks performing well, maybe, especially United States, SP 500 stocks. But we all know when somebody asks me about such a things that, oh, it's very good to buy Bitcoin, or it's very good to buy maybe dollars or something, I say usually it's against the laws of investments. It's against these laws. So of course we can see for 10 or 20 years a good performance on something. We can see some things like negative correlation between stocks and bonds, positive this correlation type correlation of the stocks and bonds, the 60-40 portfolios and so on and so forth. But it's not the basics principles of the market. And so Niels told about this many times, Jerry told about this, and Moritz and other guys. So it's very important to understand for us that if we do such things like not diversifying a market, we can, of course, we can for 10 years, for 7 years or 8 years, we can be in a profit, but sooner or later it will be a period when we will be in a not very good situation. And if we have not a proper risk management, we will lose our money. And if we, as I said just now, and if we will have not proper diversification, problems with the diversification issues, so we can be in a low performance for many years. So it's very important to be diversified across the sectors. And as I said before many times, the less money you have on your account, the less diversification possibilities, abilities you have. So for me personally, I do this research on correlations, try to find uncorrelated return streams, but it's not always, of course we all know that correlations not always exist in such way as we see, but I try to do my best in this. But if you have amount of money that is necessary for a good diversification, of course I think that like Jared does, we must not think much about the correlations, but we must think about weights of the purpose. For example, if we have, for example, 100 stocks and 15 commodities with equal weights on each market, for one stock and for one commodities, for example, it's not a good idea. So I think that it must be equal weight. If we lose for example, 15 basis points, we must have maybe 50 stocks, 50 commodities, 50 bonds, and maybe 50 currencies. If equal, we have equal loss. So we must think about this also. For example, if we have 200 markets and we lose 15 basis points from each market, so it must be not must be overrating here. So if a person thinks that he has a lot of different stocks and only few commodities and it's okay, it's not okay, because we have anyway this loss of correlation. It's not always, of course, we have examples when correlation doesn't work, but financial sectors, in every crisis, when every crisis occurs, we see the same situation with financials. We see how they go.
So yeah, I like this topic, Bruno. Um, it's just one of those things where we've talked about this, and I just don't think people are very serious with analyzing trend following when they throw up the S&P. It's kind of to prove that it doesn't work almost. And as I've said many times, if you want to go ahead and trade, do a research back test on all the S&P 500 stocks to get this diversification. You've got the outliers as well. It goes against our outlier idea that you're going to get the big outliers more often if you trade the individual markets. As wonderful as the S&P has been, but I don't think they're that serious about analyzing trend following. However, what do most of the trend following CTAs do? The same thing. They are totally fine with trading these indices with all of their PhDs and research and back testing and knowing full well, if I know it, they know it, um, that it would be a lot better to trade the individual names. It's daunting. It's intimidating. It's the markets are there for in the currencies and the commodities and the interest rates. There's 20 or 30 or 40 of each, whatever. So I'll trade them all. Yeah. Okay. Cool. So someone else has done the work for you. Now, if you want to trade the indices, if you want to trade the single stocks, well, where do I start? What do I do? Well, there's 20 some or 30 some indexes. Okay, I'll just do that. I mean, it's the dumbest thing I've ever seen in my entire life, especially if you're a large CTA. But, it's just not putting the client first. It's AUM and management fee related, not to rock the boat. I mean, they'll come in and screw up trend following with all of the silly risk management, money management, vol management, but they're not going to, and they'll brag about that, about how wonderful that is, but they're not going to do anything with the single stocks. It's nuts.
Hey guys, Moritz here. I think it's fair to say, guys, I didn't see a single woman on the call, unfortunately. We need more women on the Clubhouse, that's for sure. Um, by the way, I think it's a major goal for me to change to the stocks this year. Hopefully by the summer. I need to find the time to get the work done. I already know how I want to do it without having run a single test on it. Um, and and It's funny, this week I was on a podcast with Corey Hofstein. It hasn't been released yet, and I brought this up as well. I think he cut it out because the discussion immediately went into, well, if you're trading the single stocks, then you need to fund the position. And it's like, well, it's not necessarily true. You can buy stocks on margin. And So you're essentially paying a funding spread to the broker. That's fine. And then, he thought, well, then there's other things. When you trade the S&P 500 index, then you get the market efficient, the global most efficient tax withholding rate that's implied in the futures contract, because it's arbitraged so perfectly, right? Whereas if you then hold the single stocks and they have a dividend event and they go X, then you may have less favorable tax treatment. And then there's borrow, and then there's repo, and all of this is true. And I said, look, Corey, I think those are all exciting mental gymnastics. I understand all of them. In my previous career, it was very important to get these things right to the basis point. But I'm trading at 20% volatility, and any of these parameters can possibly make a difference of, let's say, I don't know, maybe 10 basis points at the end of the day to my overall performance, because I'm not long all the time in the stocks. I'm trading many more instruments than just the stocks, commodities and stuff. So when you break it down, even if I lose a little bit on efficiency, because I'm now trading stocks and I'm using a brokerage funding rate as opposed to trading the futures contract and using the market rate, it doesn't really matter. And without having tested it, I'm pretty sure that the diversification benefit that I'll be getting from trading the stocks is going to be so much larger than the 10 basis points that I'm losing, because it might be less efficient from a theoretical finance point of view. So, but I think he cut this out because he was really he was fighting for that efficiency thing. And then I also, and if you want, by the end of the summer, I'll be happy to share the results. I haven't done any testing yet, but I thought about, like, how will I go about selecting the stocks? And um, I have this in my mind. I hope it's right. We'll see. But I don't want to go with any geographical diversification requirements. Like, I don't want to create a universe of stocks where, I need to say, okay, it's 10 from Japan and 10 from Australia and 10 from South Africa and 20 from Europe and 50 from the US, um, and from different sectors. I don't want to use this approach. I really want to screen the entire globe for companies that have a very specific business profile to them. And of course, they need to be liquid. So I've done a first screen. There's companies such as Bakkafrost, for instance, is a Norwegian salmon producer. The only thing they do is produce salmon. They don't produce any other type of fish, just salmon. So I'm kind of like, I'm getting exposure to salmon by trading Bakkafrost. There's AMS Chemie, which is a Swiss, polymer chemical company. They do one polymer chemical that is used in a specific application for God knows what. I'll trade them. You can trade Tungela. The only business that Tungela does is coal. They're pure coal play, just dirty coal. It doesn't have to do anything with ESG, but it's pure coal. So you can find these companies. I don't care if they're based in Switzerland, South Africa, or Norway in my examples, but I'm pretty sure that I will get the most diversification selecting them that way. And I don't also care if they belong to a specific sector, if that makes sense. So this is what I'll do. I'll just need to, yeah, get the work done.
They're great ideas, Moritz. I totally agree with you there. I think that we need to look for equities that are unique propositions, because I think that's where the outliers really exist. So, when we talk about the benefits of single stocks, what we're really referring to is the benefit of their uniqueness. And I think that's the aim of what we're trying to achieve.
But hey guys, but would you backtest it some way differently? Because I mean, you can't kind of backtest systematically the picking of these stocks. It's gonna be quite subjective, which companies you want to
Yeah,
get. So
no backtest. Throw this out of the window. I
so
just,
basically just a trend following backtest,
yeah, I'll
like a
just trade
usual.
them in the same, exactly. I'll just trade them in the same way as soybeans. And um, I think it's right. I don't need the backtest. I'm pretty sure that what I'm doing is the right thing. um, it's going to be almost impossible to backtest that. And it's going to, I don't have the time. It's so time consuming to, look at these point in time databases and figure out, what type of stock you would have picked in 1997 or so. I mean, look, it doesn't really matter. I can only make money between today and tomorrow and in the future and not in the past. So um, I'm pretty confident that what I'll be doing is the right thing to do. I have a system to protect me, even if I'm wrong. Let's say I'm wrong. What happens? It goes into my initial stop loss or it hits my exit, and I'm throwing a few of these trades away. I have all these other markets that will hopefully continue to work nicely as they do this year. So it's very, very unlikely to kill me. Um, I don't think it can kill me unless there's such a like all of these stocks. Like let's say I have a long position in all of them, and they all gap to zero. But even then, my account probably isn't going to be at zero. So I don't think it can kill me.
So you'll do it long and short both, like you'll go short in the salmon company also?
Yeah, that one is an interesting. I don't know that. I would really like to start with the long side of these trades. So this is long neutral, and then on the shorts, if they are shortable, then yes, for sure. But there, I want to have a look at that. I think Jared just mentioned Amazon, and having a short position on Amazon, that's a very easy borrow, and because everybody has it in their portfolio, and there is a lending market that's very active in Amazon and in Tesla and in Apple and all of these stocks. So those are easily shortable, and they're also not very expensive. Um, and that's fine. On Baca Frost and EMS Chemie, that may be a completely different thing. So I'd love to trade them short. This is my answer. I'm not sure if I will. Um, Maybe I need to use the S&P 500 to have equity short positions. Remains to be seen. I also don't have the historical data. The only thing that I can tell you is from my derivatives desk trading experience when I was hedging derivatives books on stocks and indices and all sorts of things. I obviously had to look at the repo market of these things on a daily basis, and I think it's fair to say that in something like a Baca Frost or any of these smaller cap type of companies, there's probably not even a lending market. You can't locate the stock. You wouldn't be able to borrow it, and that also has a broker dependency, right? Um, you have the best chance if you are with a very large broker because they will have clients. Some of their clients will hold the stock long, and they will allow their broker to borrow it out. But let's see.
Well, it's good. I like all of that. Of course, I know that at one point when I was doing my initial back testing for trading single stocks, it was in a period where stocks had done really well, recently, like 90s or early 2000s. And one of the things we needed to do was not to overweight stocks. They had trended so well that we were just getting all of this great performance from them. And my bottom line was always, and when I did this back test, was besides looking at the trade stats, was what system should I trade? And so we didn't want the stocks to we didn't want to throw in 200 stocks with alongside of 100 futures, and the stocks would carry the day if the stocks had different trends or performance or different if the different parameters, some parameters work better with stocks than others. We had to be careful. So we just didn't want the stocks. We just didn't want to choose the wrong system. And so I think that's that's kind of the was always the bottom line to me. Yeah, there's so much to say on this. You want to seek this diversification, just like you have with these other sectors, the commodities, the fixed income, the FX, and the interest rates. And I think it's okay if you have a low amount of data. Um, because when you apply these systems to these markets, one of our assumptions is they all have the same. All the markets have the same expectation. So even if you don't have a lot of data, but you've chosen this one stock, and I've done this many times, you've chosen this stock because it is without a doubt, it has a single story, a single product. It's going to give you lots of diversification, like coal, let's say, and then you want to throw that thing in there, but even though you only have 100 days or 200 days worth of data, um, because that's what you're going for. You're not going to necessarily get lots of new information by limiting yourself to markets that have 10 or 15 or 20 years worth of data, because you're not going to, by having that amount of data, it's going to be unlikely that you're going to materially choose a different type of system. So I'm going to trade the 200-day breakout, but if only I would have tested all those stocks in a better way, a more robust way, I would trade the 100-day breakout. I don't think that's going to be the situation, and you don't want to throw into your back test too many stocks or too many currencies or too many commodities. You want to have a good balance of all the markets to determine which systems to trade. And come on, we're not the first people to do this. Borrowing and all these little problems that Moritz mentioned, we're the last people to do it. The entire industry is doing it and has been doing it, and it's wondering why the hell we're not doing it. They've conquered these issues. Okay, borrowing and financing. Go to IB. Yeah, you're going to get some stocks called back if they're small, maybe, and maybe it's going to be expensive. But you know what else is expensive? Shorting the Turkish lira. That's expensive too. Whether you know it or not.
That is actually a very good point there also, but I hope it's not too relevant then in my practical trading is the risk of your stock being called away from you, which is a risk. It can happen. It cannot happen with your short futures position. If you're short the S&P 500 futures contract, you are short and that's it, and you're not giving that short back. If you've borrowed a stock, it can be called away. But what the heck? I mean, let that happen occasionally, and it's not happening to all the stocks at the same time. I don't think that is a major problem, and it's really one of these smaller things that you can have debates about, but they're not really moving the needle on the annual performance of my trading system. So I used to be excited about these things. Now they're more like a nuisance, and I don't care that much.
I agree with these points. I like these points because I think if we can imagine theoretically that some assets will work not so good with a trend following, if we apply trend following, than other assets, it means that trend following is not so good strategy. And of course it's not so. And we work with universal laws for investment, and of course, we don't need so much data, as I have said before. We must understand the logic behind this research, a logic behind this performance. And as for me, I understand it. And so I agree with this that if some, as I have just said, that if some stocks or assets or something like that don't work with a trend following, it's not very good for trend following. But I am absolutely sure that it's not so, and in a long-term period, we will see the same results. Of course, we can see underperformance on the markets, on the certain markets, and because of it, we diversificate. One of the reasons why we diversificate, but in a long-term period, the performance on each market is the same.
It's interesting. Jerry was talking about the Turkish lira. I'm just looking at the CFDs on the Turkish lira at the moment, and this gives you an idea of what Jerry was talking about. The long swap, which is a holding cost for the Turkish lira, if you are long, you receive $48.81 per lot per day for the Turkish lira. However, if you are short the Turkish lira, you've got to pay $39 per lot per day. So when you're trading the Turkish lira with CFDs, make sure you're only long.
Well, I have
Yeah,
this
yeah,
rule, that I'm going to be short in a downtrend, so that silly rule um, overrides overrides all of that. I do remember someone recently posting on Twitter about all the money you could have made in the cash lira, and I'm pretty sure Moritz corrected them, and I was like, oh yeah, I can correct you on that as well. It's a quite different chart. The
Yes.
the shorts are so bad, and they don't really do that well most of the time, and they're great for diversification. And I have made, 2014, I had a great year, yeah, because of short energies and stuff. So there has been some great trends down, but you know, sometimes it's kind of like I have to tell you, my attitude on some of these shorts sometimes is, please call it away from me, please. I can't do it. I can't do it to myself because I'm following my rules. But if you, someone out there, wants to take this short away from me, oh, please go ahead. And we've had a couple of examples of that recently, you know, um, in the Russian stocks where they went down a lot. I was short that Russian ETF, stock ETF, and I got out a couple of days before it stopped trading. But, for whatever reason, that was not a system trade, right? So, that's fun. That's good. And in the ruble, the same thing kind of happened where a lot of the prime brokers were like, get out of your ruble. That was many, many ATRs ago. So it's not all that bad sometimes to get called out of some of these shorts. But I mean, I'm just kind of joking. But, it's kind of disappointing that they cut that out of your podcast, Moritz. There's for some reason, there's a lot of resistance. Look, UCTAs are in a box. We put you there. You're crisis alpha. Your crisis risk offset. Don't be veering over into this thing. I've heard this crap about the perfect portfolio, stocks, bonds, currencies, interest, long and short. No, no, no. We don't need you guys coming out of your little niche where we've stuck you and you're futures traders and you trade futures. Of course, they weren't that keen on when I was trading single stock futures because you're getting a little bit too close to what the big hedge funds do, and we like you guys where you are. And so there's this resistance to almost the final push, the final step in getting truly the perfect portfolio that only uh, diversified CTAs offer. That there's just going to be resistance to it. Do not let them do that. Find those stocks and create that stock part of your portfolio in the exact same way that you did all the other sectors.
Yes, exactly. Yeah, I mean, I like Corey. Corey's a quant. I like his podcast. Maybe that was a bit too much. I think, some parts of the podcast were actually quite funny. We also, he brought up of course, the concept of vol control and all these type of things. I'm not going to bore you guys with that, but what we said is you have this tendency, or people have this tendency to put to see my equity curve, and this was kind of like the preface to this thing about the stocks. Is, look, I said I don't care about the 10 basis points when I trade with 20% vol. I'm kind of like experienced enough now that I really don't care about the 10 basis points. And that was like, well, we should, you shouldn't be doing that. You should always be caring about the last basis point as well. It's not really worth my time. And I'm used to an equity curve that isn't all too smooth anyways. And then he was like, well, but there's always ways to make that equity curve better and have it smoother. And I said, look, it's kind of like you want to put lipstick on my pig, but my pig doesn't like lipstick, and I like my pig. So go away with your lipstick. I'm not smoothing anything, and I'm not trying to find 10 basis points to make it better. So we're not going there. I think this is why it needed to be cut out. But I love
I'm
my
laughing
pig.
hard here.
Yeah, yeah. And there's another fun story that just as an FYI, but I used to trade a trend following strategy for the Munich Re group, and they are very ESG minded and sustainability driven. They have immense problems with trading um, commodity futures. So, the acts definitely know, the softs know, the meats know, and then it was very difficult to even get energy in. And there they wouldn't, it's like, nah, that needs to go as well. So essentially, I'm no longer doing that. And I hated this. So there's like, trend following needs to work without the commodities. We don't want to trade the commodities because, we might have an adverse impact on the world and make food more expensive. Empirically, none of that is true, but it's kind of like in German corporate culture, it's ingrained there, and you can't get it out. So I looked it up. We're having this great time being long energies and being long almost all of the commodities these days, and they make us a lot of money, and short the bonds. And if I were trading stocks, then I would be long Tungela, and that's a dirty coal stock, and none of that is really ESG. But I'm not sure what ESG is. I think it's a marketing gig for the most part, anyways. But the story is, I spoke to them just catching up. It's like, how are you guys doing on that non-commodity trend following portfolio where you're trading 25 stock indices and some bonds and a few currencies? It's like, yeah, we're having a great year. It's great. Super year. We're up 4%. So that's amazing. You're up 4%. You're vol controlled to 12% vol. You've made 4% by and you don't have a lot of positions in the equity. So essentially, those 4% they come out of the bonds and the currencies. And if you just had the commodities in, I mean, you'd be kicking the ball out of the park. But they're so proud of themselves. Um, I'm mature enough not to boast and tell them how much I'm up. I'm just, yeah. Congratulations on the positive number.
I'm always on the lookout for something new. I love new stuff. But I'm going to sort of limit it to my love for it. Is that it has to sort of fit in with these ideas of objectivity and robustness and paying attention to our core principles. Um, but I'm also always on the lookout for oh gosh, this is not new. This is new marketing. So with that said, I wanted to ask you, Moritz, do you understand what category? And I know you're more polite than I am, but of this idea that I think Corey has touted, it's return stacking. Like, what is this? And to me, when I hear about it, it's just like a multi-advisor CTA. You have a short term, you have long term, you have carry, mean reversion, pattern recognition. You can add all these things together, and maybe long S&P to boot, and you're going to get the benefit if you want to do that. Um, of diversification of strategies and ideas. Of course, I think 100 to 200 markets trend following is pretty good return stacking. But do you understand if return stacking is this new thing that none of us have ever contemplated before, or is it just a way of, is it two new words?
Yeah, thanks for asking. Honest answer is I don't know what it is. And I was too lazy to read it. It came across my screen because I get Corey's emails and newsletters, and you know, I scanned through it like the liquidity cascades and the return stacking and these type of things. But I kind of like read through it, as like, yeah, it's not really helping me in any way, or I don't get it, or I don't know what this is. So I just didn't read it. Maybe I'm too lazy, but I don't know what it is. and I don't think I need it. I don't think my pig needs it.
Yeah, that's one thing that I don't think people say about me very often because I don't really understand it either. I mean, I listen to what they say, but I can't really, I like the term. I wish I would have come up with the term, and I would have just said it's 100 markets, and I'm stacking these returns on top of each other and look at this wonderful diversification. But I think when people listen to me on these podcasts, oh, they know what I'm saying. There's no confusion there. They don't like it. They don't agree with it. And maybe I should practice a little bit better presentation skills. But I think with some of these quants and who I just don't get what they're saying sometimes. It's kind of they're interested in trend following. They talk about trend following to a degree, um, and they're certainly much smarter than the average trend follower. I mean, they're a quant. I mean, there you go. Um, but they don't quite come all the way over and embrace it wholeheartedly like I think they should to keep maybe a foot in both camps. I mean, the stocks understand all of this value growth and the equity premium, and then okay, momentum in stocks that's good too. The factor thing, I just really don't know. You just don't find very many who are able to come over and speak plainly, and so it's not confusing and truly embrace the the style that we enjoy.
By the way, I have said before, but it's very important for me, the topic about commodities. It's really very important for me personally because a few years ago, I thought, maybe 2 to 3 years ago, of course, I understood that it's good to trade commodities, but it's costly for me, and I thought that it's not necessary maybe to trade it for diversification because it was a very flattish sector and I listened in that spirit. I started 2 years ago, started to listen to systematic investors every day. And Moritz, Niels, and Jerry said that it's very important to trade commodities. And Niels said that central bank can't do anything with commodities prices directly. They can influence only on stocks, bonds, and currencies because it's financials. And Marit said that some people say that it's risky to trade commodities, and I will tell you that I think that it's risky not to trade commodities, not to have them in your portfolio, something like that. And I began to trade it on my collective account, collective 2, and so I have 2 accounts, commodities because of risk management rules there, limits there. And one financials account. So these commodities accounts are the best. They are in the top 1%. Of course, in the future, it will not be so. We all know the loss of trend following, but now only because of this, I have 2 years of very good performance in all drawdowns. It's only because I added commodities to my portfolio because of project of Niels of Top Traders and Plug, because of Systematic Investor, because of Niels, Jerry, and Maritz, and I'm very thankful for that.
Yeah, you need those markets. They are all the markets are great, but the commodities, I mean, they're also so different in and by themselves. So I can't really see trend following without them. They need to be there.
It's the most uncorrelated sector. Most uncorrelated sector is commodities. It's very interesting.
It's definitely been a good time for managed future CTAs, but can you tell what was the main issue last decade that most of the CTAs were doing poorly? Was it like a lack of trends or too many small losses added up, or lack of outliers, or how would you describe the poor time?
In
I would,
hindsight, I'd tend to say it was the reduced volatility, lack of trends associated with regulatory intervention, quantitative easing and suppression of volatility. We did get some periods of time where this low sort of volatility environment was broken, such as 2014, where we got these stellar short-term sort of great trending opportunities. But by and large, the decade following the GFC was one of extreme intervention. And I think that definitely did suppress some markets, and it created this sort of bloom in mean reversion techniques and sort of an explosion of long, these basically long S&P strategies, or these 95% of convergence strategies basically, which have blossomed during that decade.
When we're honest, can I offer a maybe slightly different opinion? Because people say the performance has been poor. Has it really been that poor? I don't know. When I look back on the period 2010 to 2020, those 10 years, yeah, I didn't have a year like this current year to date, but I don't know if poor is the right word. I mean, it has made a bit less money, a little bit choppier, but uh, still looking at the systems. I love that system. It's been great. I I wouldn't have swapped it for anything else. Um, Not even for the S&P 500, because I know that's risky. So, you know, maybe we're all a little bit carried away because the media and people, they speak about it as, right now they now want to talk up to us again. We're on we're on Bloomberg, not me, but CTAs, and the good performance is mentioned in the Financial Times and in Bloomberg and on the TV and CNBC, and those managers have their time in the sun again. But we've seen this movie play out before. It's now they're being asked questions again. How high do you see oil going? And they say, well, I have no idea. I just follow the price of oil. And we also know that at some point we're going to have a down month, and we'll be in a drawdown again, and we'll give back these profits, and we'll feel less happy about the markets. We're all affected by it, and then the media comes from the other way. It's like, look, you guys are stupid. You didn't see the exit. You didn't see the obvious turning point in the market, and you wrote it all the way down. And how stupid is this? And then they don't talk to us anymore. And it's getting colored again as, oh, it's underperforming, poor performance, not working, trend following is dead, blah 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 blah. Just put this all in the box and put it in the noise corner and forget about it.
Right.
Maybe
That's
that.
right. It's I'm always baffled when I hear this idea that maybe I don't understand the definition of drawdown like other people, but I'm always baffled when I heard it recently. Like trend followers are always in a drawdown. We're always in a drawdown. I mean, what investment is not always in a drawdown? The only one that I know of is one that keeps making new highs every day, which I mean, that's been us recently, I guess, pretty much. But I mean, isn't every investment strategy kind of quote always in a drawdown unquote? What is a drawdown? It's irrelevant most of the time. An excuse. Chasing away drawdowns is an excuse not to follow your system, or not to have a robust system with one entry, one exit, and a stop loss. You know, I went on this tirade with my buddy Mike, and who is he's in the audience, but the other day, and I wanted to see if you kind of see where I'm coming from on this idea, which is that you know, let's say for instance you're a CTA, and you trade a diverse portfolio, and then you tell somebody, well, I haven't really made much money recently, and then I guess I haven't made much in these commodities. And so you would be saying, well, what are you doing? Like, what is your problem? Like, everybody else out here is doing pretty well, and it's a lot of commodities, mostly, maybe a bit of currencies and interest rates here recently. Um, but yeah, like, dude, what's going on here? I like, no, 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 no excuse for you. You haven't made money in the commodities? Okay, so then is this a fair analogy to, well, CTAs over the last 10 years, we haven't really done that well. Well, do you trade stocks? Because I think they've done pretty well. Oh, yeah. Yeah, but it's only one sector. Well, Commodities is one sector, and that's responsible for all your recent profits as well. So, like, if you're going to kick ass into commodities, which you have, then what about the stocks? Are you not trading enough of them? Because you're certainly trading enough commodities. Are you not trading them with the right system? Are you getting out too quickly? Are you trading indices only? So, this is my point. Like, what do we need to do? If every four sectors that we trade, they all quit having trends, okay, and that's a good excuse. But if we have a commodity like trend in stocks, which we've absolutely had, and we don't make money in it, can we look inwardly and say, okay, I'm not going to let that happen again? It's a beautiful sector. There's a lots of liquidity. There's a fair amount of diversification. Yes, it does go to one sometimes. Everything goes to one sometimes. These currencies will go to one. Look at the currencies now, and look at the interest rates now. They have gone to one. Well, we like that one. Oh, that one's great because we're making lots of money. But I don't like it when it goes to one when a lot of my profits are taken away. Well, come on. This is life, and this is how the world works. You make some, you lose some. And if overall you end up making, then be happy, be thankful. Um, and then we wrap around these stocks and these markets that have a tendency to be correlated sometimes, a trend following system, which Richard has been talking about recently, that further reduces the possibility that we're going to get crushed by too much correlation because we're wrapping the trend following around it and we're not long equities. Now it's a beautiful time because half my stocks that I trade, they're short and half are kind of long. So much different than February 2020 when I was long everything. Okay, critique that. Let me know. Am I reasonable here or am I just pretending? I know it's been a tough period, but don't you think we could have done better by handling the stock sector better or simply the way that we handle commodities?
I personally think that we are most of the time in drawdown, and I can see this when I'm looking at the trend following performance versus, say, a buy and hold S&P 500, strategy. If you look at the problem is that people equate drawdowns with risk, and we know that that's not the case. But the nature of the drawdown is the important thing, and the nature of the drawdown, of the trend following drawdown, is we do sort of for a lot of our period of time have drawdown from our high watermark, but there are certain times where we get these magnificent outliers, and we get these non-linear growth in our equity curve, which more than compensates for any of that drawdown impact. So if I look at, say, Mulvaney's performance over the last 30 years, I see that 80% of the time it's in drawdown. But we do get these stellar high watermarks occurring, which more than compensate for any of that feature. But if you look at the buy and hold, say, of the S&P 500, you'll see that, between 2010 up to 2018, there might have been 5 years of effectively no drawdown. But when the drawdowns do occur with that style of strategy, they're extreme, and you get 50% drawdowns, 55% drawdowns, etc. And that's because the nature of the drawdown, that our systems basically accommodate this drawdown, and we manage the risk of that drawdown by releasing risk from our portfolio at all times through our cutting losses short at all times. So there comes a point in time where risk is fully released from the portfolio, which means that our drawdowns sort of inevitably sort of slow down. And when that sort of spurt occurs, we do this stellar uplift. And that is different to alternative strategies like convergence strategies or buy and hold strategies that hold on to that risk. And so the drawdown can be perpetual and extreme.
Don't let your life and your trading system be guided by any of these drawdown measures. I mean, trade in a way so that it's very unlikely that you will blow up. But it's a matter of perspective, this drawdown discussion. When I look at my trend following system, and let's say I zoom out and I only look at it in like 3-year buckets, I never have a drawdown, zero drawdown. I've never experienced a drawdown because every 3 years, maybe even every 2 years, I don't know, I have a new equity high. If this is the only NAV print I'm looking at, let's say the 31st of December every 3 years, I have no drawdown. Never ever. Nothing. Zero. So that feels pretty good. If you look at the S&P 500 on a minute by minute basis and you measure drawdown, then the S&P 500, without having done the calculations, but I'm pretty sure it's in drawdown 99.99% of the time, because it's noisy and volatile and it's, choppy intraday, and, maybe it finishes slightly up on the day. But if you're very granular, you're in drawdown all the time. And then you kick yourself because you think, oh, it's a bad trading system. But it's not. It's a great trading system. You just need, to have the patience for it to play out, and don't get too influenced by a, drawdown in the shorter term. I mean, especially if that drawdown is because you gave back some open profits that you're not eating into your core capital, then fine. Doesn't really matter too much.
I'm sure that the main, maybe, uh, qualities of the price of every market, every asset, is that it will change sooner or later, and it will be major changes sooner or later. And during the old history of the world, we see this, and it's a law of nature, a law of psychology, maybe, I don't know. I am sure that it's a law of nature that's changing. So we must understand that in the period where it's not so much changes, we must not to lose much money, and because of it we do our proper risk management, and also diversification helps with this. So I think it's the right point.
I think as well the fact that we are hunting outliers. Outliers in its name already says that that's not per se as frequent, but the duration could be, a longer term period. So I indeed agree as well, because in this strategy you're cutting losses short. That might be more frequent. So in terms of looking at it granularly, you'll catch more, drawdown. But again, as Moritz highlighted, and Richard as well, and Jerry, in the longer term or longer perspective, if you look in a year's time or multiple years, you will catch more outliers. So then you don't notice those drawdowns. So I think it's, as mentioned, inherent in the strategy because we are caught in losses short, and the outliers are not as frequent because that's in the name. It's an outlier.
I liked here the words of Maritz in one of the episodes of Systematic Investor, that if we have the situation that is opposite for this, and we have a frequent uh, gains, very frequently we have gains, and we have not so frequent losses, but it's very big losses. And Niels and Maritz said that it would be a very bad situation when we have a lot of profit, but when we have a loss, it's a big loss. So it will destroy our account sooner or later.
If you compare the convergent trading strategy to the divergent trading strategy, you can see why we do exist in these periods of extended drawdown. And when you consider a convergent strategy, let's take pattern recognition, or let's take mean reversion. It's basing its principle on a repetitive oscillation in the market, or a repetitive pattern in the market that has historically been repeated over a period of time. So when you adopt the trading system with that basis in mind, you expect that equity curve to catch that pattern immediately, because the trading system is designed to catch that pattern. So therefore, as soon as you turn your systems on, you expect to get a high sharp and a equity curve that continually rises. And if it goes into drawdown, it tells you that your pattern recognition or your mean reversion isn't working. That is totally different to the divergent philosophy, which says we don't know when these trends are going to occur, or we don't know when these outliers are going to occur, but we have our systems turned on. So most of the time we're catching random noise, but occasionally we catch these magnificent trending periods, which more than compensate for all of those small losses. So that means the inherent nature of our trading strategy insists that we must bear drawdowns while we are waiting for these events we never know when and where they occur.
Would it be you mentioned noise? That's quite interesting because that created a parallel in my head between noise and drawdown. So could we say that catching noise is us getting into drawdown, and when we gain a clear signal, which is the outlier, that's when, if your strategy is working as intended, will be the point where you're out of drawdown. So drawdown equals noise, and no noise equals clear signal, which equals outlier.
Yeah, drawdown equals noise, and drawdown equals convergent signal for a trend following system. So there's noise plus convergent signals, which are detrimental for trend following. So a divergent system is looking at a divergent signal. So that's when we get, we catch those outliers. So there are two contributing factors to the drawdown of a trend following portfolio. Now, when you're looking at mean reversion, you will find that noise actually assists mean reverting techniques. That's because of the nature of the technique itself. As it's traveling down to equilibrium, the perturbations of noise itself can actually give you a beneficial result to your mean reverting system. But noise is actually detrimental to trend following systems. There's a very good podcast done by the Darwin X team, which explained that in detail, which I did post up on the Twitter feed, which is very interesting to get your head around, but it certainly makes sense.
Yeah, when I asked about last decade's performance of CTAs, I wasn't necessarily thinking that it was poor performance for you guys, or that the strategy was bad. Nothing like that. It's just I've understood that the whole CTA industry in general suffered last decade. I think Richard described the reasons well about the interventions and volatility and the lack of this. Uh, but yeah, I I feel the topic brought up some heat from the memories, but drawdowns all make sense, and that's all good.
Interestingly, Marcus, when I look at the performance over, say, the last 40 years of trend followers, you see that, say, from the 1980s up until the early 2000s, there was fairly consistent performance of the CTAs, where obviously trending conditions were quite favourable, resulting in these equity curves that were you could put a regression line on them, and the regression line would sort of closely fit the equity curves of the index. But then subsequent to 2008, we got a change in the nature of it, where we get these periods of extended suppressed volatility, but then these explosions in performance in 2014, 15, and I think 16, 17. Anyway, there are two periods, and it almost looks like there was a sort of constraining of the rubber band over that period, where sometimes that rubber band broke and we got this magnificent trending periods. But the periods of good performance were sort of interdispersed with fairly long periods of probably what was regarded as underperformance, where everyone was telling us the trend following is dead. But when you put the regression line over the entire series of 30 years, you actually don't see much change in the slope of that regression line. So trends were still evident, and they were still performing very well, the CTAs, but the period between drinks was fewer and farther between 2010 to 2019. Then post 2019, we've got this explosion again, and I think this is a much more enduring explosion. For the last 3 years, we've had this very solid, stellar performance of the trend following industry in general.
Yeah, you have a strategy that targets outlier trends, and when you get them, it makes money. And when you don't have them, it doesn't make money. Wow, that's very profound. Um, so now you could complain and you could criticize rightfully, well, you shouldn't have that type of system. You know, I understand trend following is not dead. It's dead to the extent we don't have trends. I think trends are obviously going to occur in the future. Uh, but you shouldn't trade that way anyways because they're too choppy, it's too lumpy, and it's unpredictable. And don't have this predictable source of alpha that all the institutions and people want. So that is a fair criticism. We are put ourselves in a situation of where we have no idea when it's coming, where it's coming. We can seemingly go long periods of time without getting it, but a systematic approach that harvests these outliers and it doesn't get them, it's not really broken. Or and I just love that podcast that Leda Braga did, where where she said you can't tell if this trend following systems are broken because the signal is too weak, and it's not enough evidence to show that it's not going to work any longer because there's barely enough evidence to show that it even does work. I mean, that's just brilliant. I love that. And even some of the critics keep bringing up this idea that, like Mike, my friend Mike, the other Mike, criticizing trend following by bringing up this video and examples of Jim Simon saying that trend following no longer works. And when you listen to the video, he basically says, well, this 20-day breakout no longer works. I mean, yeah, okay. That's not what we do. And we're not using the 20-day breakouts. We uncovered in the late 90s that the short-term breakouts were not working any longer, and we moved away from them. Um, and then, of course, if you use Sharp as one of your metrics to determine whether the validity of trend following, then that's not going to work either. And as I've said before, because I listen very closely to Richard, it seems to me that if these trends that we participate in are going to be dominated by endogenous factors, then we need to move out to a longer term trend following process because the endogenous uh, characteristics and causes of trends demand it, and you're leaving money on the table if you're not riding those type of trends for a year or two.
Everything is perspective as well. If this year, let's say this year is a stellar year, next year is a stellar year, but the year after that is even better, how would we perceive, or not we, but people perceive the years before? So this year and next year, that was good, but not as good as the year after. So it's also about where do you place the baseline, and how far do you look back? And I think people have different definitions of those. That's why you get all the different opinions as well.
I like also in transforming that, like Neil said, we all always have a plan to do, and no matter there is a crisis, or maybe it's not crisis environment, there's different environments, and we always have a certain plan, and we do it with all our rules. It's very important, I think, and these discussions that trend following doesn't work. I think it's like Nils often said, there's no evidence and there is no white paper was written about this, and the only evidence we have that trend following is the best strategy because we see, as I said before today, that we I can't imagine the situation when the price will not change anymore. It's very strange. The whole system of all trading system will be destroyed, maybe, so theoretically, if we can imagine this. So of course, trend following is, and I like the idea that trend following is an asset class. To invest, it's very good to invest in trend following like an asset class. So here's my point.
What Leader Braga said was so interesting, that weak edge. And when you consider that 5 to 10% of our trades are the things that actually contribute to our profit, you can see what she means by a weak edge. That means that 90% of our trades are effectively noise or just random results. And we often talk about trend followers having a win rate of say 40%, but the reality is that it's only really 5% of our trade distribution that is actually contributing. But it's contributing in such a significant way. We get trades of 8 ATR, 20 ATR, 25 ATR. They're so monumental, such large events. You can see why they swamp the results of that, the balance of the statistics of 90% of those trades. So it is a very weak edge, and it is incredibly hard to statistically define. In fact, it defies the ability for quants to be able to define it. And that's why quants typically exclude anomalies from their data set, because they treat them as such infrequent, rare, sort of anomalous events that they totally exclude it. And that's actually the bread and butter we thrive on.
And for me, when I trade so many different markets, none of these trades are very material, and it's kind of like, well, so on one hand, you're like, oh, of course I'm going to do the trade. It looks stupid. Of course I'll short Amazon, or I'll do this upside breakout that hasn't worked in this market in years. But on the other hand, you can lose your focus and say, well, it's one of a million trades, and it's not probably not going to matter very much, and so maybe I won't do it. Or I have made so many. One of my biggest mistakes over the years is taking a futures market off my portfolio at the exact wrong time, and so you don't want to do that. You only keep them in the portfolio due to the diversification that they offer, um, on a daily basis. And then if you start taking markets off your portfolio, you're just going to pay dearly for it. And I have done that before, but you don't want to get into a situation. And then when you look at some of these trends, and you look at something that's gone 400, 500 ATRs, which can make your entire year, one out of 100 or 200 markets can make you 10 or 15%, then you're like, oh yeah, you better take all those trades. Entries are kind of important now, aren't they? Yeah, you're darn right they're important. Um, I want one of you guys to comment on my diatribe about trading more stocks, trading single stocks, over the past 10 years, and how that relates to trading commodities and making money in commodities. And now we're not, couldn't we have done ourselves a favor, and in the future, by not getting ourselves in a situation where we're not making money when the stocks are doing well? I mean, I think that's where we need to head. Like, how do we prevent this from happening again? If we have one sector stocks that do well, we don't want to go through another period where we're we're continuing to use that excuse as, well, you can't expect us to make money because it's stocks are the only thing moving. Well, commodities are really is the big mover now, and we're doing just fine.
Diversification. Obviously, if you go for one market, then your diversification is less than if you spread it out in between different markets. And I guess doing single stocks instead of indices makes you more loosely coupled, because every single stock or every single company that's linked to that stock will have their own, how do I say, will have their own lifeline, the way it happens. So the volatility in a single stock, I think, would be greater. I haven't tested it, but would be greater than having obviously in indices. So it just creates more diversity. And I think if we just look at the purest sense and we just aim for pure diversity, that will be great for the systems, instead of clubbing them in different sectors and just keeping it tight, like just do commodities or just do one thing.
I was just having a look at Corey Hofstein's return stacking, and it's really something that we do anyway. It's simply talking about how if you are trading non-correlated assets, well, trading with leverage can actually reduce risk and not increase it. And we've recognised that all the time with our margin-based products, which we use, which incorporate leverage into our portfolios. We're trading uncorrelated assets, so I think we can safely assume we are return stacking.
Yes, I had a feeling. So some quads are very good at trading, and some are very good at marketing. Yeah, so it's always good to have quants around with the choice of labels and names, because I think return stacking is, I like that.
So just to understand in this concept, does it mean that you need less capital in a certain market? So by kind of using more leverage, you can almost separate and diversify more, or is it different? Like trying to understand the concept.
No, Jeff, I think you've nailed it. I think it's just the fact that if you're trading unlevered, uncorrelated assets, when you apply leverage to it, you're actually using other people's money to get the benefits of the uncorrelated nature of those assets. So yeah, I think you're right.
Got it.
And with using leverage, you can trade the euro dollars bigger, and you can trade the currencies bigger to where you're creating a bet that's equal in euro dollars and currencies that have low vol to a market like Tesla, Amazon that has high vol. And so the only way to get the true diversification is through this use of leverage.
I tell you what, Jerry, I know that you were saying we're getting a lot of joy out of commodities, but I'm getting a hell of a lot of joy out of the Forex at the moment. It seems to be. I don't want. I hate talking in terms of narratives, but when Neil starts talking about this deglobalization, it's almost tempting to assume that we're starting to see the breakdown of correlations of the forex markets. We're seeing these magnificent trends in the yen, the pound, the euro. I'm writing a lot of these, and they're beautiful, clean trends.
And this is once again another sector. Niels has been on fire recently. I mean, I've really enjoyed a lot of his comments, and I've been tweeting them. But as he mentioned, this is just another sector that says that hasn't done well in such a long, long time, and we did not abandon it. So, yeah, I mean, that's the one thing that my research produced that enhances the simple breakout. Now, as you know, um, I shouldn't have to say this, but I don't do anything that is not rule based and systematized, and I don't do anything that reduces my sample size in a meaningful way. So I'm not breaking any rules. I do break rules on the VIX. Okay, you got me on that one, but not on my breakout system. So the only thing I've found that enhances just a bit of the breakout trading is a systematic approach that gets in quicker on the breakout if um, the market has been a poor performer. So if you have this market that has a lot of choppiness, the last 5 trades in a row were losers, um, you can get in my system will get in a bit quicker. And if the market was really good recently and the last trade was really a big winner, then my system will get in a bit later. That's probably more relevant, wording it that way. So
Oh,
once
nice,
again,
Jerry. So you're talking about a sort of period of congestion, then there's a strong breakout. I like that.
that's right. So I hit those breakouts, the same breakout quickly, the worse the trade has been. So how perverse is that? Not only am I continuing to trade cocoa, right, which is like a joke trade, um, but I get in quicker on these breakouts because cocoa has been so bad. So and then so then I'll get in a bit later if it hasn't been quite as bad. So it's all
I,
systematized, it's all
I
rule
love that.
based.
Add that
Yeah,
to our counterintuitive list.
exactly, exactly. So am I not going to trade the currencies because they haven't made profits in 10 or 15 years? Heck no. I'm going to trade them more. It's this is the statement we used to use. This was kind of one of the funny things that people said back in the 80s. It's building expectation. How sick is that? I mean, and so of course we kept those currencies in there, and then of course I got lucky. As I've been getting lucky recently, I added due to Arthur um, ex Quantica, I added Arthur Sepp. I added the short-term rates back in just in time he convinced me in Clubhouse, just intellectually, he was right. And I switched. I added the short-term interest rates. And just listening to Richard, he just brought back all these memories and things that I had learned in the 80s. I added back in the currency crosses. So I've got a lot of yen on. Everything is long. Every currency is long versus the yen pretty much. So I've been getting lucky in that regard. And of course, my portfolio continues to grow in the number of markets, and I continue to trade each individual market smaller and smaller. It's a beautiful thing. I'll keep going. Another thing too is that I often hear, and Moritz brought this up a while back here on the Clubhouse. He said, "Oh yeah, this was a good statement." And this is one of the first things that Moritz said. He said, in talking about doing research on the single stocks, he said, "I know how to do it before I do the research. I know how I want to do it." And I'm like, "Oh yeah." And I think that's a key component, is to sit around and think about how you're going to do it and plot your strategy in this back test of, what to do, how it should work. The trend following core principles forbid you from getting too crazy. It's a very narrow, restrictive set of assumptions and rules that you're going to use. So you've got to plot your strategy before you do this back test on how you're going to do it. And even when you get the research back, I would have a tendency to discount any sort of, oh, this is a major breakthrough. No, there's no major breakthroughs. You're going to trade every market the same way, the longs and shorts the same way, and you're going to not add rules that would prevent you from regularly doing the system trades. That's just my big complaint about vol management, money management, risk management, this overlay. All I can see when I hear about this oppressive material risk overlay is you're not doing the trades. You're supposed to buy that breakout. You're not supposed to get out until the downside breakout. But so I think this is just devastating. And I remember, it makes me think of when I hear people ask these questions on podcasts. It's like, have you researched this? Have you? And I'm thinking to myself, no, I haven't researched that, because I'm not going to do this money management. I'm not going to trade markets differently. I'm not going to trade shorts differently. I hear that all the time. Well, the shorts behave differently. It's kind of like, getting an engineer or an engineer or someone who works at Boeing and saying, hey, have you researched this idea of flying a plane with only one wing? No, I haven't researched that. That's a total waste of time. Why would I? It's going to crash. And I feel like the same thing. No, I haven't researched trading markets differently or trading the shorts differently or adding lots of different rules, because it's going to crash. I mean, why would I waste my time? So what we do in the back testing is very limited. It needs to be, and that's a huge edge for us, because we sold those breakouts and then we sit back and we're tremendously rewarded when everyone else is trying to figure out through AI and ML what's the next step to predict what's going to happen.
Guys, this has been great. Just wanted to say goodbye because I need to hop off, but I enjoyed that a lot. It's great to hang out with you guys, talk about trend following. Have a great week.
Yeah, thanks, Moritz. You added a lot, and hopefully you can come back and we can do it again. It's been a
I
lot.
will.
Miss you, and miss you not being on the Top Traders Unplugged podcast often. So at least you owe us this, a few minutes of your
Yeah,
time.
come back, Moritz. Come back.
Well, I'm going to be in your neighborhood, as you know, Richard, next week. So maybe I'll see you.
Further down south.
Exactly. I like it how you say leverage and then Jerry says leverage, and I know you're talking the same language.
Great.
No, that's been good fun. And hey, guys, have a great trading time ahead, and I'll be back on Clubhouse with you guys.
Great. Thanks, Moritz.
Seth, you've been quiet this session. How are things going?
Hey, can you hear me all right?
Yep, all good.
Yeah, I'm just driving around in the car doing some errands. Um, one thing that kind of came to my mind in this discussion, talking about back testing, one thing that I like to do is kind of torture a system a little bit. So take like a typical trend following system. One thing that I did along with Moritz and Moritz probably about a year ago, um, Moritz Hyden dug up a bunch of crypto data for us, and we separated the instruments in between the top 50 market cap cryptos that were still trading, and then the top 50 market cap cryptos that eventually went to zero. And I took just a typical, breakout system that we would use in regular markets, and then did a long only test on the cryptos that eventually went to zero, and it was still profitable. Um, I know that a lot of people consider something like that kind of torturing the data a little bit, but for me, it helps kind of prove robustness. If you can take something that you know ultimately is going to fail, and then prove that your signals that you're using will still work trading at long only, it just kind of helps prove robustness in my mind. So that was just one thing that kind of came to my mind while we were talking, especially about single stocks. That might be an interesting test to do as well, to maybe somehow compile an instrument universe of maybe stocks that failed, and do a long only test to see how it worked in a back test.
Hey, Seth. Yeah, I've talked about that before, and um, I went to the source of stock backtesting, Eric Crittenden at Standpoint, and I asked him a question: tested stocks that no longer exist. Um, so you've got this ish. People bring this up all the time of missing data, and the results would be so much different if you included all the data. The companies that no longer exist went to zero. And his response to me was, I have done that, and those stocks made about the same amount as the stocks that continue to trade. So it's exactly what we would expect with trend following. Is there's not going to be any fall off if we get enough markets in a data set. We're going to see the same thing. We're going to see that average trade be about the same in the total set of data and the subsets. So I thought that was like one of the greatest things ever. One of the best trades ever would have to be Enron, long Enron and short Enron. I mean, we would have crushed that, right?
Yeah, so I'll ask you again. I know I've asked you this in the past. Are you ready to start trading some cash cryptos? Because to me, you're going to get the same diversification from trading a big universe of cryptos as you will trading a big universe of single stocks. And with the fact that cryptos never close, you have a lot less gap risk there. So I think it's a fruitful opportunity for those who are willing to stick their necks out and be first to do it.
Yeah, that's a really good question to put to me, since I'm always complaining that CTAs won't open up a brokerage account and trade single stocks. Um, so I need to be more open-minded in that regard and open up a crypto account to get full access. And I think it's probably a bit different. I'm not, and I think the the Ether and Bitcoin futures have been fantastic, and they have been embraced by hedge funds and trend followers because it's a future, because it's that little bit of the puzzle. It seems normal to us. We just throw it in our FCM account. The SEC as well is sort of saying we don't want any cash ETFs In Bitcoin, you can do a futures ETF. How crazy is that? The futures are deemed to be safer or more comforting than the cash market. But I do think that in the back of everyone's mind is the safety of your ownership of these coins, and getting it over, getting
To
clients
carry
to feel
more risk
comfortable
in the
with it is another big thing. It's kind of like if you can find lots of people who want to invest in crypto only trend or whatever, all this younger generation of people. Um, and then you can find a few people who want to invest in a trend following futures fund, but maybe it's hard to find people who really can get excited about both.
I tell you what, Seth, what I'd love you to do with your podcast, I'd love you to sort of do a sort of an introduction to this, what you're talking about, and demonstrate how we can do this in the trend following world. I'd definitely be interested in listening to that podcast if you ever decided to make it.
Well, we're so I'm kind of helping Moritz and Moritz with their kind of crypto project. I'm sure a lot of you have seen it on Twitter with the Afe Mi Bafe, and they've now started a website called the Monkeyverse DAO .xyz, uh, which is kind of the collection place for everything having to do with the NFTs. We have a community that's been established via Discord, which is kind of like a social media slash bulletin board site, um, where we talk about all things trading, be it macro, be it crypto. And I'm actually running two model portfolios there, both with classical trend following. One is a macro portfolio, very similar to what we're all used to talking about here every day. But I'm also running a crypto only portfolio using trend following. And for both of those, I'm doing daily updates where I run the system and post the trades and give a little bit of commentary on the weekend. If anybody's interested, that's probably the best place to look now. Would be that Discord server, and I'll put a link on Twitter for that so everybody can check it out as they have time.
Thanks, Seth.
That's quite interesting, Seth. One question, because I've seen the well, I've looked at the crypto market for quite a few years. I think since 2013 or so, and I've seen, except for like Ethereum and Bitcoin, the major coins, I've seen quite a few coins rise and fall with the pump and dumps, exchanges dropping. Obviously, now it's getting more legit. There's more scrutiny around it. So things, and especially with regulation, depending on how it goes, there's a bit more protection on that side. But how are you viewing, especially not the main coins, looking into those? Because trading those is one point, but obviously there are coins that stay alive, and there are coins that you know after a year of trading, then suddenly drops off the exchange or something like that. So, how do you view something like that?
I mean, it's the same with stocks. I mean, we have our entry, we have our exit, and probably most importantly for crypto, we have a stop loss. And the good thing with like I said, with the crypto markets, they never close, so you can leave a good till canceled stop um, open all the time to protect yourself in the event that you get one of those coins that just falls out of the sky um, very, very quickly. And just like with stocks, you have to be very careful with your position size. I don't risk more than 25 basis points per position in the crypto market. So pretty well protected on the downside between small positions and having a stop in the market all the time.
Well, I would say
Appreciate
that
it.
I disagree about uh, this need for this gap risk protection. I don't. Gap risk is not such a big idea. I'd much rather have my quiet weekends to myself and not have the crypto or any the oh gosh, all the markets trading on the weekends too. That would just be too much, right? I don't think it's an advantage. I don't think it's necessary. Um, I do think I'm going to, and I kind of have already carved out a maybe call it a fourth sector, and that is this crypto sector. And so I have in there the Ether futures and Bitcoin futures, and then a handful of stocks of companies that are in that business. Um, and I think I have asked you, Seth, or I have copied information from what you've said or written to try to find more of these companies and which companies are the right ones to have in my portfolio. Um, but and I don't pay much attention to this, but obviously, it's anyone can see that these companies, at least the ones that. One of the things also I'll do is I'll go to an ETF that is a crypto ETF, and I'll get their stock holdings. And so I feel like I've done quite a bit of research on what companies out there are part of this new sector. Um, and they're all correlated to the Bitcoin and Ether, which are correlated to each other, which, okay, I'm not going to pay that much attention to, but it is worrisome. And hopefully one of these days it'll be a bit different. And these companies have even performed worse than Bitcoin, recently. Like they're all at kind of all-time lows and trending lower. So hopefully this will be a true sector to add. And I don't want it to be part of the currency sector. I don't think Bitcoin is necessarily much of a currency in the way that the other currencies are. And nor is it like gold. And I guess also it's problematic that it seems to be correlated with the NASDAQ or stocks in general.
Just an FYI, I saw that Brian posted the link to the site I was referencing in the notes down below. So thank you, Brian, for doing that. And if anybody wants to check out those portfolios, that's where to look them up.
Yeah, too bad you can't, at least I can't copy that link from the app. That's a bummer. That's an improvement that Clubhouse needs.
Ah, that's weird. I tried to copy it and put it in my notes, but using my phone, so I put it in my notes and then kind of did it that way.
I'll put it on Twitter here shortly as soon as I get my my hands free.
You can copy it. It just copies the entire entry. So it's fine. Yeah. So it does work. You can definitely copy that link. No problem.
I would just add, kind of when you're talking about how a lot of the cryptos and crypto companies are correlated to Bitcoin and Ether. I would say that is true, but I would say the same thing is probably true for most single stocks with the S&P in general. But then you get the outliers like Tesla, like Moderna, that are still those big outliers that you want. So it's kind of what the exit's for, right? You stop out the poor performers and let the winners run and take advantage of every outlier, no matter where it comes from, be it a stock, a commodity, a bond, and that's what it's all about, right?
I agree. I think a better example would be they're not any worse than the currencies and the interest rates today. Now, stocks, I think there's a lot of stocks in downtrends now, big downtrends, and have been for a long time. And then of course that's where we're going to make our money. Over the long period, like, are we seeing some sort of diversification in the trends? Um, I'm not that concerned with what everyone else is concerned about. Is in a big day in the S&P, everything's up, and then next time it's everything's down. But then in a week or two, the uptrends are still going up and the downtrends are still going down. That's and so hopefully that can break. And like I said, I'm not that concerned with it but hopefully it can be kind of Because look, at some point, hunting the excuse that we're hunting outliers is we can't carry that in the sense that we use this thing where we say, well, I'm not going to pay that much attention to the commodities; they're all going up because we're hunting outliers, and not every some of them are going to have 500 ATR moves, and some of them are going to have 20 ATR moves. Well, that's true, and so then we kind of say, okay, it's unlikely, but I'm going to trade Brent crude and WTI because maybe that can be a difference. And I've definitely seen differences in heating oil and crude. Okay, yes, with the WTI and the Brent, but if there are 12 other similar crude contracts, we kind of wouldn't want to trade all 12 probably, or 14. So there is a limit, and so we have to see something somewhere um, to continue to build out this crypto sector with companies and coins, and I think hopefully over time as this matures, or maybe matures is the wrong word, but as we get more years under our belt with this industry, we'll see some divergence of long-term trends, and we'll see at least these companies that are in this industry making some money and having some big outlier moves.
Yeah, I kind of see it. I see probably in the future that crypto becomes more of an instrument class rather than maybe a separate asset class, if that makes sense. It will almost be like futures in that it's just a different way to access risk markets, because you're seeing now a bunch of different protocols that do different things, um, and almost the token, or the crypto is just the way you access that risk rather than being um, a sector. It's more like an instrument class, I think, is the way, kind of the direction it's going to probably go.
Yeah, yeah. I don't think I understand that totally, but that's good to know. Yeah, I mean, and it would just be too much to ask for it to be a whole separate category or a separate sector. Yeah, so hopefully, but there's a lot of time from a trend following point of view to fully or to understand the crypto space better. Um, I do love trading it, and I do love having it, and getting the crypto, having my fund have access to the crypto, all the possible markets. I do think that's a good idea. I'm not going to be a hypocrite and complain about people not trading stocks and open up a brokerage account and then write off. I should be have an intensity about me that that with the crypto that I have with the stocks. Okay, anybody want to raise their hand or say some parting words? Um, Question, bring up another topic. We're getting to our 2 hours here. And don't forget to check Twitter. Maybe I'll try to do spaces next week at 8 a.m. Trend Following Trading Club, 8 a.m. at on Spaces. But just watch the Twitter and see if we're going to make that jump and start that experiment. But if anybody wants to say something now, please go ahead. All right. Another good session. I appreciate everybody being here, and it's been fun. Thank you, Richard, for making the recordings, and hope everybody has a good weekend, and we'll talk next week. Bye.
See you, everybody. Bye.
Thanks, everyone. Bye bye.
Bye.
See you. Bye. Bye, all.